This is Ali Salarian, broker at REMAX Success Realty, and today I'm going to have a brief about the recent Q&A conference we had last week or last weekend. It was on Saturday, talking about the new rules and regulations which started on December 15 by Canadian federal government related to the mortgages, new change. So I want to outline two things today. One, what is the strategy of the government behind those changes? That's one thing. Deep analysis and find out what the government is looking for, the federal government. The second thing is talking about the interest rate, the fixed versus the variable. And as per my experience, former banker, which one might be good for you, and what exactly is the driver behind these two interest rate mechanism. So as you see here, this is the Q&A conference we had with the mortgage broke arena, and it really worked very well. It was very useful. It was 1 hour and 40 minutes, but was a lot of details, a lot of questions. I believe many consumers, whether buyers or sellers, benefited from this, especially first time home buyer. Now, what happened is, let me just talk about the strategy based on the changes. So let me go to the sheet which Rena was sharing with us during the conference. So let me start one by one. So if you notice whether the changes are, the first one was about 30 years amortization on insured mortgage, which is below 20%. This is one thing. And the second one is the cap increase on the insured mortgage, again, the one which is below 20% down payment, to be increased from 1 million to 1.5. This is the second one. The third one, the stress test for switch mortgages or conventional mortgages. And the fourth one was talking about insured refinance. So, and then there was a rental income supporting buildings and rental and all of this and other things. So I noticed most of those changes, whether it's increasing the cap for insured mortgage, which is 20 less than 20%, or expanding the amortization for, again, for insured mortgage, I believe these both rules are toward the first time home buyer, right? So I see those are really motivation and encouragement for buyers and first time home buyer. When it comes to the stress test, I'll find stress tests are for those people are owning a house and they want to renew their mortgage and switch lenders. That is toward the buyers, not necessarily first time home buyer, because first time home buyer here assuming didn't buy anything yet. The other one, which was talking about 5% and 30 years amortization if you're buying from a developer, that one was for first time home buyer and investor buyer. And you go down, there's the rule about the LTV go up to 90% if you want to renovate your house and borrow against equity available in your property. You can go up to 90%. That is again about toward or the benefit of the owners, the existing owner of the house. So now big question is here, what is in for investor? Let me clarify one thing. In the market there are three category of the buyers. I'm talking about buyers here, not the sellers. So we have first time home buyer, we have existing buyer, and we have investor buyers. Investor buyers defined by those people are buying second and third and fourth property, those properties which they are not going to live in, because it's kind of impossible to live in two properties. And even by CRA definition, government definition, your principal has to be one property. So if you buy the second or third or fourth, that is considered investors. And investor mostly they acquire, rent it out, then sell it after a while, or maybe they flip it. The first time home buyer is very, very simple, as those are buying property for the first time. And existing buyers or homeowner, those are owning a property, whether they want to upsize or downsize or whatever we call it, right size. So if you notice, the government is encouraging buyers, existing buyer, and mainly first time buyers with those rules, not really necessarily the investors. Why? As you see in the market right now, there are investors on one side, and there are principal homeowner buyer on the other side, and they're competing against each other. Now, the government found out one of the reasons the price shoot up and went really increased big time is because when the investors, they come with, let's say, deep pocket, whatever, and they want to go and compete with the buyers, regular buyers, whether the first time or existing homeowners. So the government want to direct them, like, seriously want to direct them to different directions, which is toward pre-construction. So by giving them only 5% and 30 years amortization if they are buying from the builder, option or feature, or something new for them, telling them, for investors, do not go after resell, go after pre-sell. Two reasons. Reason number one, they don't want them to go and compete with the homeowners or principal buyers, they say principal residents. Rather, they go and compete, or not compete, let's say they go and help the developer, the builder, a lot of units, whether they are condo or low rise, a lot of them out on they are in the market. And nowadays, as you know, since 1 year, it's they are in there are big challenges, they are in trouble, especially condo buildings. So there is nothing especially special for a condo, but overall, I was talking today with somebody, a realtor. He says low rise shouldn't be in a problem, but I am seeing everything right now in the problem, but assumably more high rise, which is condominium buildings. The reason why, very simple, a lot of supplies. So this is the message, and the message is very clear by now, and that's what I'm trying to get into deep analysis, what the government strategy behind, the federal government strategy behind the recent mortgage rules. Let me go to another, jump to another subject, is which is the interest rate, which I was talking about. Let me find an article from ChatGPT on that. As give me a second. Let me go here and find out what I'm talking about. Is ChatGPT. Everyone uses ChatGPT. So I kind of lost it, but let me go back to my ChatGPT and give a little bit explanation about that. Okay, explanation. What's happening right now in the market? Most of the people are asking the $1 million question, I call it. Here we go, which is, shall I go variable or fixed? Now let me explain the outlook, the future, where those interest rates are directed to, which direction are going based on the federal government, back again, federal government, the Bank of Canada outlook and projection for the economy, and ultimately bankers. The variable is, well, let me start with interest rate. Any interest rate compound, that means the interest rate itself. What those combination, what is in the interest rate? If you go for ChatGPT and ask a question, and this is, I know it as a banker, there is the cost of funding, the cost of borrowing. Let's put it this way: I go and raise a deposit from depositor, and it costs me, let's say, 2.5%. Okay, as an example. Then there is something called risk premium. Risk premium is in case of default, what my how much I have to have a risk premium in order to cover my default, in case if I want to go after that borrower and recover that money. Then there is an inflation compound of it. The inflation, what's the inflation right now in the market and all of that. And there is a profit margin, which is cost of managing the assets and liability, deposit on one side and the asset on the other side, which is liability considered is a loan and asset considered deposits. Then you have the premium, the term premium. This is the last one, to be honest, I'm not really familiar with, but let me make it very simple. Now, the risk part of it, which is the most important here I want to talk about, is So if the market in a situation, no jobs, no money, economy is not doing well, something is happening, and the banks they get worried about the default, what they're going to do, they're going to increase their risk factor. Or similarly, if they are dealing with a borrower who is working in a risky factor industry, let's say like tourism, or who is credit is not that great, or who is on a contract base or self-employment, could be anything, right? The risk factor here is increases. That's why when you go to the bankers, you will see if someone goes work, let's say a doctor with 25 physician, 25, 20 years work experience in a government hospital, and someone who is working in the tourism industry, let's say in the hotel, and has been there for 6 months or a year. You see both of them, consider both of them, they have the same credit score and buying the same house, same endowment, same everything. You see the physician doctor or the government employee may get way better rate than the one who works in the hotel or some or self-employed or something like that, or someone with a low credit score. So this is, and there is a matrix with the banks, there is a scorecard, they use it, most of them are S&P during my time or Moody's, but I don't know what they're using nowadays, but this is how it's calculated. Now what I'm trying to point out here is if the economy is not in healthy and good condition, that factor, the risk premium, is going to go up. So that what happened back in 2008 and 9. That's very important, right? So now fix variable. Now, in my opinion, the fix is linked to the government bond or bond yield. Most of the bonds in the market out there, whether they're corporate bond or government bond, those bonds where the banks link the fixed interest rate to them. Now, bonds are, in my opinion, are a global uh, installment of financial installment. Let's put it this way, right? Global. The reason why, because corporate are global, all over everywhere, and even government bonds sometimes they trade globally, right? It could be a bond for foreign government or a bond for international company. So what's happening in the global market, mainly in the US, is going to impact those bond yields and ultimately impact the fixed rate. That's why a couple of cut happen, the reaction, especially the latest and the last cut, the fixed rate did not reacted accordingly, meaning didn't go really, really down. However, the variable did. Why? Because the variable is mostly impacted locally and impacted by the inflation rate, which is going down. Now, November inflation rate in Canada was 1.9, down from, I believe, 2 point something, right? That's good news. So, what I'm trying to say, if we are in such regime like today, what's happening in the market, where the interest rate is on cut and the outcut as per the Bank of Canada interest rate is going to be from 3 to 0.5 overnight Bank of Canada rate to 2.5 by hopefully by end of 2025, meaning the rate is going to go down. You should, in my opinion, personal opinion, stick to variable. If you want to go fixed, 3 years fixed, 5 years, 4 years, 2 years, whatever, remember one thing, it's linked globally. And what's happening in global arena, especially south of the border, especially what happens in the US economy and all of this, and reaction of the company with what the policy of the new administration US coming in, it is seems to me is going the other way around, right? Back to the trade war possibly to have to happen between Canada and US in case of if the tariff implemented. Remember, if the tariff implemented on the both side of the border, whether in US and Canada, is going to cause an inflation. And when there is an inflation and slowdown of the economy, what the bank is going to do? Very simple: cut further more the interest rate. I'm afraid the interest rate might go back to the below 2.5, which we had before, and head maybe close to the zero. Then that's what's going to come back on very positively on the real estate market, which happened back in the COVID. If assuming the trade war is going to happen between US and Canada, which is now a big question. We don't know what is going to happen, yes or no. So as a borrower, the outlook, what's happening in the economy with the interest rate, it is going down. When the interest rate goes down, the price of the property is going to go up. But don't be mistaken here. Not all properties, not all type and class of properties. It is going to go gradually. It's going to start with a smaller one all the way to the bigger one, excluding the condos, because condo has supply issue, supply problem. Now, we're talking mainly here townhouses, semis, smaller detached, medium-sized detached, bigger detached, and then custom homes. Custom homes, bigger detachment, they might be in positive growth probably by end of 2025, maybe early 2026. And condos might be back by starting growing by end of 2025, beginning of 2026, and maybe 2027. So that was the message today. I wanted to explain about what is what's the breakdown or the compound of any interest rate, right? And how it works and what they are linked to, and put my insight about the recent government policy to about the mortgage and what the message behind that. The message clearly: buyers, first time home buyers, existing homeowners, which existing if they want to renew their mortgage, or they want to go upsize or downsize, and finally the investor, which the only product, the only encouragement for them to go toward pre-construction because of the oversupply of pre-construction and the challenge. So bottom line, the government doesn't come and through policy just like that. There are people sitting out there and they are thinking a lot about which policy is the best for the economy. They do research, they do consultation, they look at the results, and they come with policy. That's my message for today, and hopefully this was really helpful, and I encourage you to go and watch what we recorded the other day. I know it's 1 hour 40 minutes, but believe me, it's very useful. It's like a conversation between two or a bunch of people sitting and asking the right question about all of this, which uh, we're talking here experts, especially the mortgage broker we have. We are lucky to have Rena. In the future, I'm going to hook up or invite more mortgage broker and bankers to the same such a style of like recording or material. But definitely we're going to improve, because that was the first time we had a couple of problems and mistake. We were only on two platforms, LinkedIn and Facebook. Somebody says, why don't you go YouTube live? Yes, we're going to do that in the future. Thanks for you, and I wish you all the success. If you are a buyer, don't waste time. I wish you all the success and successful real estate, and enjoy your holidays. Bye for now.